Hello, everyone, and welcome to our weekly call. I'm Rupert Watson, Head of Asset Allocation, and I'm going to start by giving a brief update on the economy and markets. Dan will then discuss LDI, liability-driven investing, a low-risk way of managing pension fund assets that has protected funding levels over the last few weeks. Amanda is then going to discuss the impact of COVID-19 on executive pay. Darren will discuss the key considerations for employer covenants in the COVID-19 environment. And Nick will then finish by discussing the importance of thinking holistically about well-being and keeping your people connected and engaged at this rather unusual time. Please feedback any comments or suggestions you might have, and please reach out to any of us if we can be of any help to you. So turning to the first page, and the first page is a picture of US equities going back to 2009, which is pretty much the low in markets after the financial crisis. And you can see that markets have gone up periodically, mostly over that time, with a few modest down movements as a result of various different factors. We then, at the start of this year, reached a new all-time high, somewhere near 4,300 on the S&P 500, before we saw a fall of close to 40% in US equities and indeed other equity markets. And since then, however, over the last 3 weeks, since we started really doing these weekly calls, we've seen a huge recovery in equity markets, with S&P 500 and most global equity markets making back about half of their losses. And in fact, we're back to roughly where we were this time last year, or early this time last year. And the question, therefore, perhaps, is the crisis over, at least from a market perspective? And our guess is not. And we turn to the next page. The next page shows the level of unemployment in the UK. The level of unemployment in the UK going back a number of years. As can be seen in this chart, it says 2009. Actually, it goes back longer than that. Over the last few decades, to 1970, shows that the unemployment rate is at the moment 3.9%, which is pretty much the lowest level to the 1970s. But we've seen from what's happened to on the right-hand side, new claims for universal credit, which have jumped, and from what we can see with our own eyes in terms of shops and other things being closed, that we're going to see a huge jump in the unemployment rate. It's likely to jump to, my best guess, perhaps to somewhere near 10%. Nobody really knows. But most likely above the levels seen during the financial crisis. In the US, the jump in the unemployment rate is likely to be even more significant. And the unemployment rate in the US might jump to as high as 20%, which would be well above any level seen in the last several decades and the highest since the Great Depression. So I think in terms of the economy, there's a lot more pain to come, and it's too early to sound the all clear on global equities. If we turn to the next page, that shows what's likely to happen to corporate profits. And again, it highlights that perhaps it's too early to give the all clear to equities. So the line that is fairly flat is what JP Morgan were expecting to happen to corporate profit over the next few quarters, so slowly going up. While the red line is what their new forecast is, again on the left-hand scale, with a huge plunge in corporate profits this quarter and next, before recovering slowly back towards where it would have been over the next year or two. The dotted line, which is measured on the right-hand side, is the cumulative loss in corporate profits over the period. And this line is likely to reach somewhere near minus 100, meaning that a full year's worth of corporate profits will have been wiped out. So at a high level in relation to equities, we're not chasing the equity markets at the moment. We have a largely neutral view. We think the policy support will be great for equities, but we do think that with corporate profits plunging, it's too early to get in. And of course, there are huge uncertainties about the lift at the start, the restart of the economy, when it will be, how vigorous it will be. So we're holding fire on equities. But as I've discussed in previous calls, we do like investment-grade credit, high-yield bonds, which we all think are at attractive levels. We think are at attractive levels, well above normal. And while the defaults will go up, we think they'll be supported by governments and central banks. And at that point, I'm going to hand over. So thank you.
Thanks, Rupert. So Rupert's spoken a little bit about equity markets and some of the corporate impacts of COVID-19. And of course, they sit on the return-seeking asset side of things in terms of the investment spectrum. I'm going to speak a bit more about risk reduction and specifically LDI. So LDI stands for liability-driven investments. And our LDI funds primarily invest in fixed and inflation-linked UK government bonds, but they can hold swaps as well. And they're typically used as a means of risk reduction. That might take the form of a pension scheme hedging its liabilities, or it might just take the form of holding a low-risk, safe haven type asset as part of a wider investment strategy. Some of our funds also use derivatives as a means of leveraging this exposure, and of course looking after those derivatives and the collateral around them has been a key part of my role over the last 8 weeks or so. So looking at slide 6, like most markets, COVID-19 has had a significant impact on UK government bonds. The two charts here show us the change in UK gilt yields since the 28th of February. These are effectively interest rates on UK government debt, and those same interest rates that are used to discount pension scheme liabilities. And since the 28th of February, there's been 3 clear key periods in terms of the market, and they're separated by the coloured markers at the top of the charts. Directly below the light blue, we have what I might describe as a fairly traditional flight to safety. Equity markets started to wobble a little bit, maybe fall 3 to 5%. And so investors got a little bit spooked, and they looked for safe haven assets, of which gilts are a primary example. So the value of gilts went up, and the yield of those on gilts fell. What followed below the purple marker was a quite remarkable 10-day period. This is where COVID-19 really took a hold of global markets, equity markets falling maybe 20% plus from their peaks. And investors were looking to raise cash very quickly, and they were fairly indiscriminate in terms of which assets they sought to do that. So the price of pretty much everything fell. Gilts, of course, are a very liquid, easy to sell instrument, so they were no exception. Gilt valuations fell, and yields rose around 0.8% over a 10-day period. And to put some context on that, the biggest 10-day rise in interest rates over the prior 10 years was about 0.5%. This was 0.8%, so bigger than anything we've seen dating back to the global financial crisis. Maybe to put it more prominently in capital terms, the longest maturity, most interest rate sensitive gilt is the 2068 index-linked gilt, which shed about 35% of its value over that 10-day period, at a time, of course, where pension scheme liabilities were also falling quite dramatically. At the top of that peak, we then have to fall back down in yield, and this is under the darker blue marker where government intervention really takes hold. And the main focus of the gilt market of that is Bank of England restarting quantitative easing, QE, Bank of England committing to purchase £200 billion worth of gilts and bonds as a means of effectively promoting business lending and investment and really kickstart the economy. So that new purchasing of gilts really pushed yields back down again. So if we look at that chart, looking at the start and end of March, we see yields actually in a broadly similar place, but we're in a very different market. We've got the Bank of England purchasing bonds through QE. We've also got a government that's looking to finance over £300 billion of support for households, businesses and individuals, things like the furlough scheme, business rates relief. And they don't need to pay for that. And one of the ways they'll be paying for that is through an increasing amount of government debt, gilts they issue. And so within QE and new issuance of government bonds, we have 2 pretty massive supply and demand factors which are really going to drive the gilt market over the coming weeks and months. So that's a little bit about market levels. What does this mean actually for our clients? Well, firstly, where our clients are pension schemes investing against pension scheme liabilities, really big moves in liabilities. We look at a pretty standard pension scheme liability profile. Those liabilities would have risen 6%, fallen 15%, and then risen another 8% in the space of 4 weeks over March. The clients that are using LDI, when their assets are well hedged against their liabilities, the impact on the funding levels has been reasonably small. And that's really the beauty of LDI as an approach and as a fund and as a solution, is being able to withstand those big moves in liabilities without massive changes in funding levels. That's the liability side of the balance sheet. On the asset side, again, in terms of our funds, some really big moves. Some of our leveraged funds move more than 20% in a day at the most extreme point, but that's commensurate with what we'd have expected, how leveraged the funds are, and that's what their benchmarks look like. And crucially, the funds have been behaving like we expect them to, which is comforting. has been a challenging market environment, though trading has been harder. Bank trading desks are no longer open in the city, they're all operating remotely, and so trading these assets at any significant volume has got trickier. So we've been working closely with our investment managers and closely with our trading teams within Mercer to ensure that any client trades we place are absolutely essential, and when there are large volumes, we look to stagger them and delay them if we can. On the derivative side, the cost of gilt repo, which is our primary derivative instrument in our funds, has got more expensive as we went into quarter end. Again, by minimising the amount of flows into the fund, we were able to minimise the impact and pain of that. And the good news is that since quarter end, those challenges in terms of trading and the cost of derivatives have really settled down. We remain in daily contact with our LDI managers just to ensure we're aware of the market and which we're operating. If we now move to the next slide, slide 7, in terms of our leveraged funds, because it's exactly this kind of market environment when you're using derivatives, you need to be careful. Derivatives amplify the changes in value of your assets, and so you need to ensure that leverage levels remain at sensible points. Specifically, it's when gilts are losing value, so yields rising, that leverage multiples on the funds increase, so that's where we need to be careful. What slide 7 is showing us is our leverage monitoring framework. So blue looking at the yield on the funds, the horizontal pink line there is that early warning as leverage starts to rise. As you can see, as we got towards the back end of March, we just about kissed that level, and we got a warning from ICE that leverage our funds was getting a little bit higher, so we considered whether we needed to restructure or deleverage the fund. But as you can see, yields quickly fell back again, so the market did our job for us. To provide some context, the purple line above that, that's really the point at which the LDI manager would look to cap our leverage on our funds. So we had another 60 basis of headroom in terms of potential interest rate rises before anything would have happened automatically on our funds. It's really comforting to have this framework in place and see it working in such volatile markets. Finally, a very quick word on swaps. We could use interest rate inflation swaps to do much of the same things we're doing in our LDI funds. You may have heard me talk about in the past that gilts actually yield more, they return more. They're a cheaper hedging asset relative to swaps, so they're our preferred LDI asset. This hasn't really changed during this market. In fact, the differential between the return on gilts and swaps has got slightly larger, but only marginally so. So gilts remain our preferred instrument. Though, of course, at times like this, we see value in having flexibility and being able to be nimble. So we do continue to consider the full market in terms of LDI solutions to ensure not only we do get the best available approach for our clients, but also one that's robust for the medium term. So that's me. I'm now going to hand over to my colleague Amanda Flint, who's going to talk to you about some of the HR considerations around COVID-19.
Thank you, Dan. We're going to look briefly at the impact of COVID-19 on executive pay. Inevitably, this is going to be a very brief canter through some complex issues, so feel free to contact me after this session if you'd like some more details or have questions. So, an area that concerns many companies is how remuneration committees should react to the current crisis when reviewing executive pay. So where are we in the pay cycle? Many December year-end companies, whether they're listed or unlisted, are currently reviewing pay and incentive awards to their senior executives. And even those with alternative year-ends can see these issues coming up over the horizon. Of course, many companies are looking at packages with a critical eye. If a company is furloughing employees or taking any other form of government support, it needs to consider very carefully whether it's appropriate to award pay rises or bonuses in 2020. Even if it's not receiving government support, it should also consider its stakeholders, not just the shareholders, and for example, dividends may have been withdrawn, but also other stakeholders. What about the employees? How have they fared? And further, what's the impact on any with zero-hour contracts? How suppliers been treated? You can see from our chart on the slide that reductions in fixed pay for executives is not uncommon in response to the crisis. A much smaller proportion of delayed or cancelled bonus payments. So just to shed some light on that, many companies feel that where the bonus relates to the performance to the end of 2019, it's unfair to penalise recipients for later events, reasoning that those events will impact on the pay in 2020. That said, the challenge for management teams is that they typically have to make high levels of contribution during a crisis and use innovation and ingenuity to navigate companies through difficult times. This means that setting targets for annual bonus in 2020 may be tricky. The level of uncertainty means it can be difficult to set financial targets. So typically, the best response is to set a basket of performance targets based on the latest assessment of the impact of COVID-19 on the company. Alternatively, it may be worth waiting and setting the targets later in the year. Another approach taken by many companies is to state that the RemCo will exercise its discretion when assessing performance at the end of the year. It will take into account changes in circumstances and the strategies used by management to deal with them. One of the biggest challenges is dealing with long-term incentive awards. So for existing or in-flight awards, recent events may mean that the performance targets won't be met. Now, it's very controversial even now to change performance targets for existing awards that have not yet vested. The preference is to wait for the vesting date and then exercise discretion to permit or restrict vesting. Not surprisingly, restrictions on vesting are far more popular with shareholders than the exercise of discretion to increase vesting. What about new awards? The question should be asked, does the number of shares need to be reduced in those new awards? So a brief bit of background, typically long-term incentives are awards of shares equal to a value of a multiple of salary. So for example, it might be shares to the value of 100% of salary. Now with current low share prices, this equates to a greater number of shares. The general practice, where there's been a sharp dip in share price, is to reduce the number of shares in the LTIP award equal to 50% of the share price fall. Our slide shows some examples of such a response. So RemCos are going to need to consider whether such a haircut is appropriate and adequate as a response. Given the circumstances and unpredictability of events, RemCos will need to consider the use of discretion, whether now or at the vesting of bonuses or long-term incentives. RemCos typically dislike using discretion because it exposes them, and particularly the Remuneration Committee chair, to criticism. But using discretion is probably unavoidable to respond to these difficult times. So scenario planning and modelling outcomes is a good way of dealing with the fallout from COVID-19. We've been working with clients and contacts to craft an approach that's robust from the perspective of stakeholders, appropriate to the context of the organisation, and incentivises strong performance going forward in these challenging conditions. So I'll now hand over to Darren to discuss the impact on the employer covenant.
Thank you, Amanda. I'm Darren Masters, Head of Mercer's Covenant Consulting Practice. Rupert, Daniel, and to an extent Amanda have touched on some of the market and economic impacts of COVID-19 and particularly on the financial performance of employers. And what I read into this is that impacts will likely be felt across the spectrum of covenants supporting pension schemes. In the majority of cases, traditional considerations around the employer covenant and thinking about how that feeds into valuation assumption setting, recovery plan lengths, and also levels of investment risk that trustees are comfortable to run, are going to be very much second order, with the business as usual matters to be reconsidered when business returns to usual. In the current COVID-19 environment, the primary short-term focus has to be on the ability to survive the crisis and emerge as a solvent going concern. The alternative of insolvency and entering into a PPF assessment period is rarely going to be good for scheme members. So how do we approach this? Trustees will want to know, and employers will likely need to be willing to share, details on how COVID-19 is impacting upon short-term profit and cash flow projections, with cash flow and liquidity being a prime consideration. As part of those cash flow considerations, this will need to address the availability and access to existing debt facilities. I've already seen a number of examples of situations where clients have actually taken debt facilities and drawn them down into cash resources so they're readily available to see them through the crisis rather than potentially calling upon them at a time when they may be less able to do so. That is in part driven by concerns that covenant tests may limit facility availability, in particular where coverage is measured against earnings. We've got a number of examples of industries where they're going to be significantly reduced or indeed in circumstances zero earnings for a period of time, and those may cause technical covenant breaches from a banking perspective. In those circumstances, it's important to understand what approaches are being made to lenders and what the attitudes are of those lenders, including whether there have been any waivers of covenants, both short-term and longer-term. In light of the across-the-board impacts we're seeing, many businesses take steps to conserve cash, and steps taken we've seen include deferrals of rent, rates, tax payments, deferral of capital expenditures or significant capital expenditure programs, halting or reducing of dividends, deferring of debt repayments, both mandatory and discretionary, and of course cost cuts from the staff perspective with furloughing and other staff cost reductions. Some of this pain may of course be alleviated by access to relevant government support, but timing of access to those funds may add additional and significant cash flow pressure. Finally, in cases of real financial strain at direct covenant level, there may be a need to consider other liquidity resources from new debt or shareholders, both within groups and potentially from public markets. Pension schemes themselves may of course need to play a part in deferring pension deficit contributions or potentially paying pension expenses directly from scheme funds where they've previously been paid out of company resources. Longer term, there will be winners and losers from the COVID-19 impact. Competitive positioning may be altered, providing either opportunities for future growth through acquisition or organic growth for the strongest, or on the flip side, for the weakest companies, creating risks of future restructuring or risks of being acquired. That, though, is tomorrow's problem. The polar focus for now should be on ensuring that the covenant is capable of riding out the COVID-19 crisis and able to emerge solvent and able to rebuild back to pre-crisis levels. And at that point, I'm going to hand over to Nick McClelland, who's going to talk to us about the importance of employee engagement.
Thank you very much, Darren. Hi, everybody. Dan said, Nick McClelland. I sit within our health business today, and really focus of this particular session is all around the challenges that people are facing at the moment through a total well-being lens, but also some practical hints from a digital perspective of how you can keep them engaged during this period and the importance of that. I'm not going to dwell too much on the challenges. Over the last 2 weeks, my colleagues in health have spoken about the importance of mental health and indeed some specific protection mechanisms we're trying to help clients through at the moment from an insurance perspective. I guess today's message is really all about the holistic nature of well-being and ensuring that we understand just what our people are going through during this period. And I'll finish with a quick kind of case study as to what we're doing within Mercer at the moment for our own people. But ultimately, I tend to think about the well-being challenges falling into the 4 key buckets of physical, financial, mental, and social well-being. I think it's fairly well documented at the moment that employers must not overlook the psychological impact that it's having on people from a mental perspective. And indeed, I think there has been reasonable focus on understanding that that there is a different way of working whenever people are in the same house. Consistently getting out, using that 1 hour of exercise a day is obviously something that a lot of the public are championing themselves. I think less focus necessarily is going on what the financial impact could be for people over the coming months. Sometimes for some individuals it actually might be quite a good time, an opportune time to save money, commuting costs, etc., that can be repurposed and to think about saving. For others, they're facing financial challenges that they just didn't have to face before. Simply feeding a family of 4 or feeding a family of 5 people 3 meals a day without schools and so on at the moment can be a huge financial burden for people. So at this moment in time, I think it's really important that starts to factor into the way we think about our people during this period and the hardship that some might be facing, or helping people be smarter with their money at this point is truly important as well. But the final bit I want to focus on, which is really a key focus for this session, is really around social well-being, something that doesn't get a huge amount of attention. And often, in fact, when I see well-being strategies for organizations, they tend to focus on the mental, physical, and financial aspects. Social has been a missing one for a while now, and I think it's been coming to the fore with what we're all going through. Coping with social isolation, coping with family circumstances, space and time to have your own thoughts, and of course the importance of friendships are throwing up challenges that, again, many people maybe didn't have to think that they would need to deal with. If we just take the simple example of the move to agile working, which has been quite slow and painful for a lot of organizations over the last few years, we've suddenly had to accelerate that, and with the general commentary in the market being that actually, when we don't need offices in the future, we've proven that we can, for many office-based workers, operate remotely. But of course, for some people, that's the worst news. They go to the office, they go to the work environment for connection, for friendships, and actually, I know personally, I find that quite challenging, being a bit of a social butterfly myself. And so, from that perspective, we've been particularly looking at how digital solutions can help clients at this point, basically built around a new digital approach where we're thinking about things that can help people with both their well-being, but ensuring they remain engaged and connected at this point as well. We're building that around 4 pillars, which I think are quite different for the industry, really. The first is all about bringing people together in a digital community. Never has it been more important that people are connected at this moment in time. And again, using tools that we're familiar with in our private lives, such as social channels, have never been more important. So again, you haven't considered this yet as a mechanism to keep engagement high within your people, rather than the traditional email and internet routes. We think this is a very powerful way of connecting people. It's also a great opportunity to think about habit forming. It's often said that the holy grail of well-being is behavior change. And actually, there is a great opportunity with people not having to commute, as an example at the moment, to help people build the habits around well-being as well. And again, we're investing heavily in digital techniques to help individuals form the habits around that exercise regime, that mindfulness regime, or even the savings regime that might be needed for individuals. And again, it's something that's quite exciting at the moment that we believe can support people during this period. Never been a better time to focus on the individual. A lot of words in this space about personalization and making the journey more personal for people. I like to think of it as an individual journey, and again, the opportunity to connect with people and send more tailored content around well-being. It's a great opportunity at this time. And finally, something that I think is largely missing from the way we communicate benefits, well-being, pension schemes, whatever it might be, is this idea of bringing gamification and fun into that. And again, we've seen some great examples of how we've done that with this recent digital launch at Mercer. To finish up on that, and again, just by way of information, we are looking to help clients for the next 6 months with an enhanced digital version of this solution. But we launched a version of an application to our people in Mercer over the last 2 weeks. In fact, it's been running in the health business for a little bit longer, about 3 months. And we've seen incredible engagement, people accessing this digital application multiple times a week, and average use over the first 2 weeks of the COVID working from home period was about 35 times per person per week login, which is just fantastic in the space. And we've seen incredible suggestions coming through from a well-being perspective and people connecting. We've had individuals who have been setting up virtual yoga Zoom sessions and advertising it through the digital community. We've had people set up quiz nights to create that connectivity for individuals. We've seen the traditional sort of cycling clubs jump out and individuals set up group-wide cycling clubs to join. We've been able to weave in mental health content and physical health content about the home setup at work, and of course promote the things in the organization that people maybe lose sight of or lose track of in the endless internet benefit system, the HR systems that exist. So being able to have an easy place to locate your EAP, employee assistance program details, your 24/7 digital doctor care anywhere, as an example, or any other initiative that you might have as an organization. The overall message, think about well-being as holistic at this time. Individuals don't look at it through these traditional lenses of mental, physical, financial, and social. They look at it individually as a collection of all of those things. Now is the time to really up the communication, up the engagement, and digital has never had a better moment to be focused on in the organization. So that's it for me. I'll hand back over to Rupert.
Okay, well, thank you very much. And thank you very much for everyone for joining our webinar today. I do hope you found it useful, and I hope you're able to join us in our next webinar next week And if you, of course, if you have any questions for any of us or anyone else at Mercer, please just reach out. Thank you.